Hello, Jason Lamoureux with Coldwell Banker Commercial in Victorville, California. Welcome to our 2020 virtual High Desert Real Estate Symposium. Today we have Dr. John Husing. Dr. John Husing is a research economist who has specialized in the study of Southern California's growing economy since 1964. For decades, he has produced city and county-specific economic development strategies for the region's local government. With his significant understanding of San Bernardino and Riverside counties, he assists the Inland Empire Economic Partnership as its chief economist. Dr. Husing's extensive study of the region has led to economic strategies that combine analytical work with extensive interviews with executives and entrepreneurs to understand the forces shaping Southern California. His firm, Economics and Politics Inc., based in Redlands, California, has produced project-specific economic impact studies for transportation and water agencies, housing developers, environmental entities, and the ports of Los Angeles and Long Beach, California. In 2007, the Los Angeles Times listed him as one of the 100 people wielding the most influence over Southern California. Please welcome Dr. John Husing.
Hi, I'm economist John Husing, and what I'm going to be doing is giving you a revised forecast on what I anticipate happening through the entire year 2020, including the 3 months that have already occurred, plus looking at what the full result will be once the 8 months to come are done. You'll notice on the screen I have the arrow pointing at fear, because I think that's basically the public's attitude as to where we are right now. Now, I always like to start my work off with a confession of what I said would occur a year ago and what in fact did happen. I said I thought we'd create 38,200 jobs, have a growth rate of 2.5%, and unemployment of 4.2%. What we ended up with is 35,000 round figures, 700 jobs created, still pretty darn strong. Growth rate a little slower, 2.3, unemployment down at 4.0. So if we look at how the economy is done, all these blue bars are growth. There's the Great Recession. And what you see going on here is for several years in a row, we've been adding jobs fairly aggressively. The biggest number, we added 64,000 in 2014. There's the 35,000 that I just talked about. We sit 19.1% above where we were before the recession when this particular year, 2020, started. When we talk about forecasts, an important number to realize in the Inland Empire is what we expect to happen to population growth. It is anticipated by the State Department of Finance that we're going to add another 1.46 million people out here. You'll notice that's almost double Los Angeles, and it is 400,000 more than Orange, San Diego, Imperial, and Ventura counties combined. So this is where the action is going to be long term. It'll take our population up to 6.1 million. Right now, our population sits at 3.66. So if you think it was crowded running around here recently, imagine another 1.5 million people almost. Now, looking ahead, clearly the key to the immediate year that we're in is the coronavirus. As of yesterday, San Bernardino had 2,182 people that had it. 97 have died. Riverside County, for some reason, almost doubled at 4,164, with 161 having passed away. Now, really important to my work is what's taken place with unemployment. The state has lost 3.7 million jobs. People have filed for unemployment insurance. In addition to that, both Congress and the Federal Reserve Bank have poured literally trillions of dollars into the economy with the idea of trying to keep it going and maybe even increasing where it goes. Now, this is the gross domestic product. Gross domestic product is the total of all the stuff and services we create in a year in the United States. You will notice it had slowed down recently and at the end of 2019, and as 2020 starts, the gross domestic product is down 4%. That is the first shrinkage since the Great Recession. And that's the first quarter, all 3 months combined. January was pretty good. February was faltering. And then March really started to dive. Obviously, April is going to be much worse. When we look at consumer spending in the US, and all of these figures affect us because these national numbers are the ocean our economy swims in. You will see here that consumer spending was slowing as the year went on last year. Now it's down 7.8%, which is a deep drop. Then we get to business investment spending. This is buying tools, buying equipment, getting new software installed. On here, what we see is it was already negative at the end of 2019, and it was down 15% in the first quarter this year. So not a good national environment. Then we look at the state. State of California honestly is a bit weird in that a state legislature dominated essentially by the Democratic Party has walked away from blue collar and middle income jobs, mostly because they're so concerned about the environment that logistics, which is trucking and warehousing, construction, which is occurring outside, and manufacturing, all three of those have been reduced. So you notice here, this blue, that's the share of the California economy that is blue collar, and it's only 22%. Then we have a little bit of clean work that pays moderately. Moderately, 45,000 to 62.5 is the median incomes in the sectors, only 6.9, a total of less than 30% of the economy. This is not an accident. State policy, particularly in terms of hurting these blue-collar sectors, is what's driving this. Another negative that we're dealing with is housing prices. This is a chart of affordability. The red bar up here is affordability in the Inland Empire, 44%. Now, what does that mean? It means 44% of households can only afford, that's what share can afford, the bottom half of houses. So it is a very weak market because of prices being high. Then we get to San Diego, only 29%. And then we get to LA and Orange County, only 25%. Really, this ought to be called housing unaffordability, because what it's saying is 56, 71, and 75% of households in those markets cannot afford the bottom half of houses because prices have soared to such high levels. This is the California Environmental Quality Act and NIMBYism in action, both of which have reduced the production of housing and caused housing prices to soar. Another issue that we face in the economy this year, and for the Inland Empire and for California, it's pretty much perpetual, are electrical costs in this state. These are the electrical costs from Colorado to Washington, 7.13 cents a kilowatt hour, down to 4.44 cents for the state of Washington. This is for industrial electricity. There's California, way out of line with all of our competitive Western states. What it says is if you're a company on, say, the East Coast, and you make propellers, which a friend of mine actually has a company back east doing, and you realize I have so many companies in California that want my propellers because there's a lot of recreational boating going on. So the guy drives this way and he stops in Arizona. He finds out that Arizona is 98.3% more expensive than California for industrial electricity. He whips up to Nevada, to Las Vegas, finds out we're 140% more expensive. With those kind of numbers, there's no way he's putting a plant in California. And again, this is policy. This is not accidents. This is largely because we've gone so far with the green agenda that we've priced ourselves out of the industrial market. Specifically for the Inland Empire, one of our difficulties is the educational attainment of our adults. What this chart shows you is 46.3% of Inland Empire adults 25 and over have stopped at high school or didn't go that far. You can see that's above LA, California, the rest of the state. Only the Central Valley is in worse shape than we are. And this is not improving, it got worse. The year before it was 45.7. If we turn around and reverse this and look at people with AA degrees or higher, what do we see there? Inland Empire, 30.2%. Now, AA and higher is people that are Associate of Arts, so they've been at community college, bachelor's degree, master's, PhD, lawyers, CPAs. We're competing against all those other areas of California. And what it says is, particularly in the South, we can't compete. So if you get a company that needs a high-level labor force that decides they want to come here, they're going to have to import their labor from somewhere else. It was 29.8, so it's improved slightly, which is good news. Now, in January, I did a forecast of the economy. What did I say? We were going to add 28,150 jobs, which was a slow downward trend, but still pretty strong. The problem is that no longer is accurate because of COVID-19. So what sector should we carefully watch? Well, that was where we were going, but we're throwing that out. So let's take a look at data on March 2019 versus March 2020 this year. Logistics and distribution, that's the big firms that you see, the large buildings in the Inland Empire, up 11,800 despite all the problems in March. Healthcare, up 6,400. A strong sector, obviously, because we need a lot of healthcare. Then we have local government, higher education, and federal and state government, all of which pay well. Yellow on this pays really well. That's essentially around 75,000 plus. And those sectors grew a little. Then we have construction, only added 1,100 jobs. There's retail trade, barely moved. We know a lot of stores are closed. That's what that means. Then there's banks. Banks are still open. They added a few jobs, but you notice overwhelmingly it's two sectors. It's logistics and distribution, and it is healthcare. And then you have these sectors down here, all of which shrank. The biggest, eating and drinking. Obviously, the restaurants are closed. K through 12 education, the schools are closed. Amusement, we're not gathering together in large groups. Accommodation shrank, not seeing a lot of travel going on. So you can see these are the really important ones. These are a real problem. So now let's go through altogether. March, we didn't shrink. We were up 12,500 jobs in the Inland Empire. April will not look like that. And so as we go forward, we're going to see issues. Now, let's start with logistics. So this is the companies that are moving stuff in Southern California. Pay in the sector, 49.1. That's pretty darn good pay. Now, what drives this sector? First of all of us are buying online now. You can see that this was 0.6 of all sales back in 2000. It's now over 11.4% of all sales. And most recently, it grew before the COVID-19 hit. It was already growing at 16.7 year over year. So that's e-commerce. Now, looking at the ports of Los Angeles and Long Beach. The way we measure cargo coming in through the ports of LA and Long Beach is in 20-foot equivalent containers. We call those TEUs. If you see a train with those big long containers, that's 2 TEUs each. Those are 40 feet long. You can see here there was quite a buildup in container volumes to a peak at 8.2 million. That's the Chinese trade taking off. You then see the Great Recession. It goes down to 6.1 million, slowly builds up to a record of 9.0. So 9 million containers coming in. Then we have the president with his tariff policies. That took it from 9.0 down to 8.5. And now with the coronavirus hitting, we're down to 7.4 with the combination of the tariffs and the slowdown in international trade because of the virus. We were down 12.9% in the first quarter. It'll be down over 20 when we get through into the second quarter. Now, with those two drivers powering logistics in the Inland Empire, one of the things that we see is industrial space net absorption. Companies coming in and filling up warehouses with goods and employing workers to maintain them. This chart, every little square on it represents 4 quarters. So the 4 quarters ended in March. 18.6 million square feet of space was absorbed by new companies. Logistics sector growth, I had forecasted last year would be 9 million. It came in at 11.2. In March, it was up 11.8, as I showed you a little earlier. Now, what are the forces affecting this sector? 1, we're starting to run out of land. 2, port volumes are declining because of the international trade and tariffs, but e-commerce has been extraordinarily strong. So what do I expect? Well, in March it was up 11.8. I think for the whole year it'll average up about 8,000. So I think once we get into the downturn part of this, it'll slow it a little bit from where it was in March. Then there's healthcare, good paying sector. 65,757 a year at the median, half above, half below. This is driven by 2 things. One is the Affordable Care Act. If you go back to 2013, 19.4% of the people in the Inland Empire had no health insurance. It was 20.5% the year before that. It's now down to 8.4% because of Obamacare. Altogether, the drop from 877 to 382 was a drop of 56.5% of people with no health insurance. That has done 2 things. 1, it's increased people's standard of living because they have health care. But the other thing that it's done is it's created a demand for healthcare workers. So you'll notice it has come up a bit, and the reason has been all of the attacks on Obamacare, Affordable Care Act, in the Congress and in the White House have not done us any services in that respect. The other thing driving this is the number of people each healthcare worker in the Inland Empire takes care of versus the state average. The state average is 25.4. Here in the Inland Empire, it's more people, 31.2. It's in fact 22.8% higher. So our healthcare workers are busier. Those drive the sector. I had forecasted last year we'd have 4,800. We in fact added 5,600. March, we were up 6,400 over March the previous year. So pretty strong. What are the forces driving this sector? 1, we're running out of trained workers. 2, there is a stimulus package heading for hospitals, which is good news. So what did I forecast now? 7,000 for the year, because we really need a lot of people working in healthcare when you have a pandemic going on. Then moving on to construction. And this is all types of construction. Construction of homes, large buildings, office buildings, retail. What do we see here? Construction pay, half make more than 52.4, half make less. I said a while ago, we have a lot of firms moving in and taking industrial space, which is good news because it's adding jobs in that particular sector. The vacancy rate is all the way down at 3.8%. There's not a lot of space left. Look how high it used to be, over 22 at one point. Not only that, we're having to build a lot of space. So the vacancy is low despite we're building a lot all the time. We're building in March 21.2 million square feet of new industrial space. That's all that construction. That is 74.5% of all the space being created in Southern California. Who's second place? The answer is it's LA, but we're creating 5 times what LA County creating. Then there's the housing market. What do we see here? The blue line shows you what's taking place with price trends. And what do we see? Prices went up to a peak of 437.2 before the Great Recession, crashed, and on up to 457,348. Those are new homes. New homes right now are 4.6% higher than before the Great Recession. The red line, what is that? That is existing homes. Peaked at 389, dropped all the way down to 155, but it's back to 370, though it is still 5.1% below the peak. But things have gotten a little bit pricey. You see here almost a straight line. That's as close to a straight line as you ever get on data on economics. And what's it say? It says home sales have been flat. They've fluctuated in a very narrow range, quarter to quarter to quarter. Now, one of the more important charts that we have is why does the Inland Empire keep adding people? Here is the middle-priced house in San Bernardino County in the fourth quarter. There's Riverside, about $59,000 more expensive. And then there's San Diego, LA, and Orange. $632,000, $650,000, $812,000. What's that tell you? It's $280,000 saved if you come to San Bernardino County from San Diego, $298 if you come here from LA, and you save $460,000 on the average house moving into San Bernardino County from Orange County. Similar kinds of numbers in rentals. 1562 is the average rent in the Inland Empire. That's about $400 less than San Diego, about $600 less than Orange County, and almost $800 less than LA County. So what's the forecast been in construction given what's going on in these various parts of it? Well, last year I forecasted 6,000 new construction jobs. What happened? It only came up 700. I was way off. March, we're up 1,100 year over year. What's the forces driving this? Difficulty in permitting lots, the Environmental Quality Act where people can stop projects, the very high prices in the housing market and the lack of supply. And then there's a shortage of construction workers pretty much across the board. So what have I forecasted now? I think it'll be a little better as we get towards the end of the year. So the whole year we're average up about 2,000 jobs. Related to this is finance, insurance, and real estate. This is the banks, the real estate companies, the insurance companies. I had forecasted they'd be up 1,200 last year. Again, I missed it. They declined 1,200. This year, they're up 700 year over year. The fact is, high prices drive this, lack of homes for sale, and low interest rates. What do I forecast now? I think it'll end up only 500 for the year. Then there are the high-paying sectors in the economy: biotechnology, engineering, law, accounting. sectors like that. Pay in those sectors, 72,436 is what the median is. I had forecasted last year 1,100, pretty close. It came up 13. Year over year, it's up 1,000. This is largely driven by the education gap between the Inland Empire and the coastal counties that we looked at earlier, showing much smaller number of people that have AA and higher degrees. The new forecast, 1,000 jobs. Then there is the sectors in real trouble. First of all, retail, trade, and consumer services. There's a part of the economy that we call population serving. It's all the jobs that directly take care of us, often one-on-one. So it's retail trade, as you see here, is Lowe's. It's hairstylists, consumer services. I had forecasted they'd drop 22.25. They actually dropped 33.50. This year so far, they were up 1,000. Here we have e-commerce attacking stores. We have a lack of available workers because a lot of people, when the unemployment rate got low, went to work in places like Amazon. And then now we have COVID-19 closing stores, closing down personal services. What do I forecast here? Negative 44,690, which is a decline of 20% by the time we get to the end of the year. The short term, it probably be larger than that. I think about 20% of who's was working there at the end of last year still won't be working at the end of this year. So that's one of the places we get clobbered. Then there's eating and drinking. As you know, you can't go to a restaurant unless you get something at the curb that they bring out to you. But sit-down meals are ended. I had forecasted 4,700 jobs in this sector last year. 4,500 were created. This year in March, it was already down to 3,900 restaurants. We're doing well going into the recession. Again, they have a lack of available workers because the income rate was strong. People's income was strong, so they were dining out. But COVID-19 has shut them down. So what's the revised forecast? Down 27,400. That's a 10% decline. And my anticipation is that it could be worse than that by the time we get to the end, get the next year. Finally and lastly, we have accommodation and amusement. Hotels, skiing, going to the movies, those sorts of things. With the coronavirus, that isn't going to be going on, probably very little of any of this for this year. The sector pays 34,183 at the median. I had forecasted 700 jobs. This year, March over March, we were down 3,600. Now the rationale, the incomes were strong. People were traveling, but COVID has shut down both travel as well as entertainment. So I think this will now be down 19,150, which is a 50% decline. If we add up the gains in sectors like logistics and healthcare, and the losses like the ones in accommodation and entertainment, retail, eating out. Here's what's happened. I had originally forecasted we'd gain 28,150. Now I'm forecasting for the year we will average a loss of 72,340. Growth was forecasted at 1.8 with unemployment at 4.3. Now growth is forecasted at a negative 4.6 or an unemployment rate of 8.3%. Now this is my website address. I'm going to post this there. So if it's of use to anyone, please go there and you'll go to a section called PowerPoints and you can download it and hopefully it will help you in your businesses. Thanks for a lot to have the opportunity to speak with you and be safe.